Oracle's $90 billion revenue target. Management is also targeting approximately $90 billion of revenue in fiscal 2027. That's a huge jump from fiscal 2026 revenue of $67.4 billion. And Oracle has gone even further. Management has outlined a long-term growth target of roughly 31% annual revenue growth through fiscal 2030. If Oracle can actually deliver that kind of growth, the company could look dramatically different several years from now. The problem is that investors are no longer asking whether Oracle has demand. The demand is clearly there. The real question:
can Oracle build enough infrastructure quickly enough to fulfill that demand? And can it do it without destroying shareholder returns? The Project Jupiter problem. This brings us to one of the most important pieces of the story: Project Jupiter in New Mexico. Oracle is building major AI data center infrastructure there. The project is already significant, with nearly 700 New Mexico residents having worked on site, and Oracle expects thousands of construction jobs to be created over the life of the project. But the bigger issue for investors isn't simply the number of jobs, it's infrastructure. AI data centers need enormous amounts of electricity, cooling, networking equipment, and computing hardware. And if Oracle cannot bring these facilities online according to schedule, those giant contracts sitting inside the RPO number cannot be converted into revenue as quickly as investors expect. That's the key risk.
Valuable only if Oracle can actually deliver it. The $70 billion capital question. Now, let's talk about the part that could make investors nervous. Oracle expects around $70 billion in net cash outlay for capital expenditure in fiscal 2027. That is an enormous amount of money. And Oracle has already been spending aggressively to expand its cloud infrastructure. In fiscal 2026, Oracle reported $32 billion in operating cash flow, but free cash flow was negative $23.7 billion, largely because of the massive investment program supporting cloud infrastructure growth. So Oracle is effectively saying, we have enormous demand, and we're going to spend enormous amounts of money to satisfy it. That can work beautifully if the returns on that investment are strong. But if customers delay deployments, infrastructure costs rise, or revenue arrives slower than expected, the financial pressure becomes much more serious.
The $20 billion equity raise. And then there's dilution. Oracle has previously announced an at-the-market equity program of up to $20 billion. Management expects fiscal 2027 funding to include a combination of debt and equity financing. The reason is simple. Oracle needs capital to build the infrastructure required to fulfill its AI contracts. For existing shareholders, however, issuing more shares means dilution. In other words, even if Oracle's business grows rapidly, investors need to ask, how much of that growth actually belongs to each individual share? That's an important distinction. The credit rating problem. Another issue investors cannot ignore is Oracle's balance sheet. S&P Global Ratings recently downgraded Oracle to BBB-, while highlighting the company's rapidly increasing capital requirements and leverage. This matters because credit ratings influence Oracle's financing costs and the amount of financial flexibility the company has. A lower investment-grade rating can also make certain financial arrangements more expensive. And if Oracle needs to keep borrowing huge amounts of money to fund infrastructure, the cost of that financing becomes increasingly important. This creates a balancing act. Oracle wants to build faster because AI demand is exploding. But building faster requires more capital. More capital can mean more debt or more shares. And more debt can put pressure on the balance sheet. So why is September 10 so important? This is where the upcoming September period becomes interesting. Investors will be looking for evidence that Oracle's incredible backlog is turning into actual business performance. The market will want answers to several questions. First, is Oracle's cloud infrastructure capacity expanding quickly enough? Second, are major AI data center projects progressing on schedule? Third, is revenue growth accelerating towards the company's $90 billion fiscal 2027 target? Fourth, can Oracle maintain healthy margins while spending tens of billions on infrastructure? And finally, can the company finance this expansion without putting too much pressure on shareholders or its balance sheet?
Those answers could determine whether the current Oracle bull case becomes stronger or starts to crack.
A huge backlog is valuable only if Oracle can actually deliver it. The $70 billion capital question. Now, let's talk about the part that could make investors nervous. Oracle expects around $70 billion in net cash outlay for capital expenditure in fiscal 2027. That is an enormous amount of money. And Oracle has already been spending aggressively to expand its cloud infrastructure. In fiscal 2026, Oracle reported $32 billion in operating cash flow, but free cash flow was negative $23.7 billion, largely because of the massive investment program supporting cloud infrastructure growth. So Oracle is effectively saying, we have enormous demand, and we're going to spend enormous amounts of money to satisfy it. That can work beautifully if the returns on that investment are strong. But if customers delay deployments, infrastructure costs rise, or revenue arrives slower than expected, the financial pressure becomes much more serious.
And that's exactly why the next major Oracle update matters so much. If Oracle can show that infrastructure is coming online, customers are taking capacity, and revenue is accelerating towards that.
Oracle has already won the AI demand argument. Now it has to win the execution argument, and that could determine what happens next for ORCL. This is Uncle Capital. If you found this analysis useful, make sure you subscribe for more stock market news, AI investing stories, and Wall Street analysis. Thanks for watching, and I'll see you in the next one.